Good afternoon, everyone. Thank you for joining our afternoon conference call today. My name is Tyson Mavar, one of the retirement advisors here with the retirement group here in Texas. Today, we're going to be talking about some important issues with regards to retirement investing. For those of you who aren't as familiar with us, Retirement Group's an independent financial advisory group that works with corporate employees and specializes in helping people transition into retirement and manage retirement assets. Many of you may know us. Maybe you were referred to us from a co-worker or know us because we know your company benefits plans. And that's one way that we help people maximize their retirement income and maximize and improve their retirement situation before they leave their company. Today, we're going to talk a little bit about our investment philosophy, the importance in general of value investing, and also the importance specifically today in the environment that we've found ourselves in here in 2021, and why we think there's great principles to be learned from this philosophy. Now, what's happened in the last couple of years? Well, we've undergone some pretty unprecedented levels of government spending. And of course, it's possible that was required to get us through what was a fairly tough economy as a result of the pandemic. But unfortunately, you can't get something for nothing, and there are going to be consequences to this higher government spending. So let's talk about, from an economic perspective, how this works. Well, first of all, government spending is going to equal higher taxes in the future. So when we spend our taxpayer dollars, we're going to have to repay that at some point in the future, which means we're going to have higher taxes. And this is has its implications on retirees and could be a big detriment to somebody who has a large portion of their retirement wealth in pre-tax accounts. And what I mean by pre-tax accounts, that would be your 401k plan for the most part. It would be your pension plan, whether you take it as a lump sum or as an annuity. And it'd be your IRA. So for a lot of people we work with at the various companies whose plans we specialize in, that's the vast majority of their wealth. And it's results in an unknown liability in the future, an unknown tax liability, because we do not know where tax rates are going to be in the future. But if we anticipate higher tax rates, it's going to be a risk to a retirement portfolio. So this is one thing that we're focusing on with folks. But one other detriment of government spending potentially is inflation, a higher cost of living throughout retirement, which is something that we also have to plan for in predicting higher expenses on everything that we buy in retirement. And most people we work with have a retirement career of 30 plus years in many cases. So that's a long time to be planning for what our expenses are. So we want to, if anything, stress test our plan and make sure we absolutely, with a high degree of certainty, have enough money to retire whenever we choose that time to be. Another implication of higher government spending and lower interest rates, or driving interest rates down in an effort to stimulate the economy, which is what was done in the last decade, but especially the last couple of years, which creates inflation. Unfortunately, what that's going to create on the back end is higher interest rates. And this has several different detriments, one of which are fixed income assets, which is our bonds, could be losing value. Higher interest rates typically mean declining bond prices, which is not good in a retirement portfolio. Many of you also know that your pension plan, or at least many of your pension plans, lump sum payout is correlated with interest rates. And there's an inverse relationship here, meaning higher interest rates are going to result in lower lump sum payouts. Both of these are big risks to retirees who haven't yet retired. And it's going to mean that we need to be a lot more proactive and selective with our investments in retirement. And as it turns out, there's actually some opportunities that come with these future implications of this higher government spending that we've seen in the last couple of years. So let's talk about some of these implications, as well as some of the opportunities that we may see going forward in the future. So first of all, let's talk about value investing, the philosophy. Well, value investing is the idea that we're investing in businesses. Whenever we're buying stocks, we're buying businesses. We want to buy good businesses, high quality businesses, and we don't want to overpay for those businesses. And how do we figure out what's a good business? and what's a good valuation for a company, and therefore what company might be a bargain or on sale, we have to look at the fundamentals of the company. So we have to look at the income statement, the balance sheet, the statement of cash flows, and we compare the fundamentals to the current price. There's different ratios we look at, such as price to earnings ratio or PE ratio, also price to book ratio, PB ratio, which is what a company costs per share relative to its book value per share, or the assets that it has minus its liabilities. And so we have to look at stocks as if we're buying a business rather than just buying a line on a chart, which is what many people unfortunately rely on. We call this technical analysis. We prefer to use fundamental analysis and look for good long-term business opportunities, but make sure we're never overpaying for those opportunities. And our primary objective here is to avoid permanent capital loss. And this is even more important in a retirement plan because one of the biggest risks a retiree faces is outliving their money. And of course, when we invest in stocks, we're going to experience some temporary capital losses. That's what we give up to get growth in an investment, is certainty. And so fluctuations are one of the certainties that we do have, is that there's going to be volatility or fluctuations in the value of our assets over time. But make sure to differentiate between temporary capital loss and permanent capital loss. And that's what we at the Retirement Group are primarily concerned with, is avoiding permanent capital loss for our clients. And by buying good businesses and also having patience, we can do this on average. And this is our goal with our clients: long-term money, the money that they don't need immediately. Now, if we look at value stocks, the opposite or the antithesis of a value stock is a growth stock in many cases. And so let's just look at this chart here. This is value stocks versus growth stocks. And specifically, growth stocks are stocks that we're willing to pay a premium for because we expect their earnings to grow at a higher than average rate. And eventually those stock prices, we hope, will be warranted by the earnings of the company or the value of the assets that this company has. Now, this is a chart comparing value versus growth for a number of years, going back to about the year 2000. And you can see here, there's periods where growth will outperform value. This absolutely happened in a variety of different circumstances. And this has also happened for quite a bit of time just in the last decade. So let's look at another example of growth versus value stocks. You can see here where it's green, this is where value stocks outperform growth stocks. And where it's gray, this is where growth stocks outperform value stocks. So you can see it's almost like the changing tides in the ocean. Value stocks sometimes outperform, growth stocks outperform. And when the tides change, we call this a rotation. You can see, just looking back to 1984 is what this graph represents, that when value outperforms, it does so very substantially. Although once we get to about 2009, we see a rotation into growth stocks, and we've seen growth stocks outperform value stocks on average for almost 12 years now. And that's one of the longer lengths of this rotation, this growth stock outperformance that we've seen ever. So we don't know exactly when this rotation will happen, but we're confident, number one, that over time value stocks have outperformed growth stocks just in general, but especially if we can make sure that we're investing in value stocks, even when growth stocks are outperforming, we're likely to have a better investment experience. We're likely to protect our capital better. And as an ancillary benefit, we're likely to make more money over time with our investments, or at least that's what we've seen historically. So let's just go over an example of a business, a very simplified example of somebody who's going out and buying a business, which is what we're doing when we're buying a stock. It just is a piece of a business rather than buying the entire business. So let's look at this example flower delivery business that's for sale. The cost to buy the business, $200,000. The book value, which is assets, what we own, minus liabilities, what we owe, for this particular company is going to be $170,000. So how do we figure it out? Well, it has no debt. has 5 delivery trucks that are worth 160,000 total, and it has inventory, which I guess would be the flowers that we're planning on selling, worth $10,000, and no debt, so 170,000 book value. The company makes $30,000 in net income a year, and the business owner decides to keep 24,000 of those profits, which we would consider potentially a dividend. If we're paying ourselves 24,000 as the owner, that's just like the dividend we receive when we buy a stock. So is this a good business to buy? Well, there's a variety of ways to look at how good this business is. If we're looking at a price to earnings ratio, the price, of course, $200,000. The earnings of the company, and this is the total earnings, of course, would be $30,000. So we'd take 200,000 divided by 30, and we get a 6.6 price to earnings ratio. Now, what does that mean? How does that stack up? Well, on average, the price to earnings ratio of the S&P 500 is something that we look at as a benchmark on the US stock market, has been about just under 16. So if we have a price to earnings ratio of 6, that could indicate a bargain. We're paying less than the earnings suggest we might have to pay for an alternative company, which we also may not just compare to the S&P 500, but we might compare that to the sector or the industry in which that company exists in, the flower delivery business, for instance. So it's just a very simplified example, but this is what a good value investor does, is looks at the company under the hood, the actual fundamentals of the company. But then we also not only have to consider the value of the company, but we also have to consider the price. And there could be a great business that we really like, everything about the business, but if we don't like the price of the business, we might just put it in the no pile and move on to the next company. Now, we've seen some unprecedented levels of high government spending, like we talked about sort of what that means in the long run on average. And oftentimes it's not immediate, these negative implications of high government spending. But let's talk about what we're doing at the retirement group to help our clients capitalize on the current environment, especially with the stocks or the equities that they have in their retirement portfolios. Well, first and foremost, we want to take advantage of price volatility. So the fluctuations or the uncertainty of prices of stocks. Volatility can be a bad thing in a portfolio, because on the negative side of volatility, when our stocks are down, we're not going to be able to, or we're not going to want to sell them for a loss. So hopefully we have some other assets that aren't down in value that we can sell to create our income in retirement while we wait for our stocks to recover. And that's where asset allocation comes in, having the right mix of stocks, bonds, cash, and potentially alternative assets in our retirement portfolio. But there's also opportunities when the market is down or when stocks are on sale, that we can take advantage of these price volatilities and find some bargains. And even if you're somebody who believes that the market as a whole could be overpriced today, which many people do believe, that doesn't mean that we shouldn't necessarily invest in stocks or that there's no bargains available. It just means we might want to avoid the indices or avoid the entire market and be more selective with the stocks that we buy safer stocks that maybe have less debt, have good and repeatable earnings streams, and look at all the fundamentals of the company before we choose to buy that company, rather than just buying the whole market and being forced to buy expensive companies. Make sure that we take advantage of market irrationality. And an example of this is investors becoming too fearful, irrationally fearful, and the stock price of a company going down lower than it otherwise would because of this irrational fear. But on the other end of that is irrational greed. And we're seeing certainly plenty of that recently in the stock market, with all these companies that are trading at massive multiples to their earnings, massive multiples to their actual assets on the books. And so avoid those mistakes is the high end of volatility, and maybe even capitalize on some of your gains. If you originally picked a good stock that was at a good price and now its price is fairly valued or overvalued, that might be time to switch gears and find an alternative investment for that money. Try your best not to get caught up in the herd. It's very difficult. We're all human and we find strength in numbers. So listening to what our neighbor is doing or what our coworker is doing, listening to even a financial advisor. Like, we always encourage people to get multiple opinions and do your own due diligence, come up with your own opinion, but make sure that you're not getting caught up in the herd, because that is what creates some of the most expensive mistakes that we've seen in previous markets, is treating the stock market like a popularity contest and just buying what's popular. And as a result, overpaying for a stock, which is in many cases a very risky position to be in. And like one of our favorite investors at the Retirement Group, Warren Buffett, says, be patient when others are greedy, and also be fearful when others are greedy. And on the other end of that, be greedy when others are fearful. And take advantage of the fear in the market, because that's when sometimes the best opportunities exist, the best bargains exist. And do your best to find managers that not only have the ability to go to cash. Many mutual fund managers and index funds have a directive that they must be fully invested. Might be 95% of the fund has to be invested. Whereas there's other managers that have the ability to go to cash. In other words, if there's not bargains available, which is many of the managers that we prefer today, they believe that there's not a lot of bargains available, so they are not going to force a purchase in an investment that may be overpriced just to be fully invested. The downside of this is there could be cash drag on the portfolio because cash doesn't grow and it doesn't pay much interest. But the upside is that you're going to be in a much better position if there's not a lot of bargains on available and on sale in the market. And then once eventually those bargains become available, not only do we avoid the downside losses of the market with that cash, but now we can redeploy that cash back into the market when now there's more bargains available to do so. Now, we're trying to, again, remember, decrease our risk. And by doing this value investing strategy, by buying what's on sale, we are accomplishing this goal. So buying something on sale, not only are we reducing our downside risk of losses, we're also increasing our upside potential for gains because we bought that on sale. And typically with investments, most people think you have to take more risk to get more reward. Well, with value investing, you're actually accomplishing two objectives at the same time: reducing risk by buying on sale, and an ancillary benefit, of course, is that you're going to have a better growth rate over time if we can avoid losing money, which of course is rule number one of value investing. And unfortunately, the reason that not everybody's a value investor, even though this has performed better than any other strategy that we found in investing, is because it requires patience, which most humans do not have, especially with their money. And it requires discomfort with investments. In other words, you may not be making as much money as some of your friends buying the popular stocks as the market reaches the top, but you're certainly going to be happy when things turn around that you weren't following the herd, although it required some discomfort to not be a part of the herd while you waited for your solid businesses and solid investments to pay off in the long run. And when we look at history, what it's shown is that the best time to retire, it turns out, are when stocks are on sale. Unfortunately, the most uncomfortable time to retire is when the market's down and when stocks are on sale. This is especially the case if you have a lump sum pension and you're rolling that pension over. If there's not a lot of bargains available, it's going to be harder to find good opportunities for that pension. Also, it's going to be difficult for you to retire emotionally when interest rates are low because your bonds aren't going to be paying as much. But as it turns out, when interest rates are low, companies have to pay your defined benefit pensions at a higher rate. They have to give you more money when interest rates are low. And that's why we see a lot of people starting to consider retirement because especially as interest rates have started to go up on both the corporate bonds and the treasury bonds, both of which companies use to calculate pensions. And most of these companies give you a little bit of time where you can see the value of your pension, how much it's increasing or decreasing within the next month or the next quarter before you have to make that decision. That's something we encourage everybody to be proactive about. If you're considering a lump sum, is making sure you get the timing right so you don't leave any money on the table and you walk away with the most amount of money possible. And this is going to be a big thing to focus on if you're approaching retirement, and something we're absolutely focusing on with our clients right now. Dividends, it turns out, pay more than bond interest in many cases, certainly right now because yields are so low on bonds. So stocks have become even more important. Doesn't mean that we necessarily should have a very high allocation to stocks, but we may need to have other alternative investments such as cash, like we mentioned earlier, a safer asset that we can use to produce income in retirement when our stocks inevitably go down, which happens, may happen a few times during your retirement, several stock market corrections. So just making sure that we have the correct allocation given the amount of cash flow that you're needing to produce, or at least that we're predicting that you're going to need to produce, which is why the cash flow analysis is so important. And we stress that so much as you approach retirement. And if you manage your emotions, you're going to be financially rewarded on all the decisions you have: when to retire, how to spend money, right? Paying cash for something versus paying interest to accelerate your consumption rather than saving for that purchase. And especially when it comes to investments, by avoiding emotional decision-making, which is what we're trying to do with value investing, you're almost certainly going to have a better investment experience. Unfortunately, 74% of Americans over the age of 50 do not have a written plan for their retirement. And we can't stress this enough. There's a variety of companies out there that will do this for you for free, complimentary, and we're one of them. So if you haven't done this yet, or if you're a client of ours, or maybe somebody's considering working with us and it's been a while since we've updated your financial plan, your cash flow analysis, please don't hesitate to take us up on this opportunity. It doesn't cost you anything except for a little bit of your time. We'll give you an idea where you stand, and we'll give you some suggestions of things you could do now to improve your position to retire if you haven't done so yet. And if you are already retired, things that we might encourage you to do, whether it's from an investment standpoint, a tax standpoint, or a decision-making standpoint, such as when to take Social Security or ideas for estate planning. This is the best way to do it, is by running your cash flow under a couple different assumptions and taking a look at what decisions might put you in a better position for the future, having more money in the future for yourself or maybe your beneficiaries if that's important to you. If you'd like to schedule a meeting with us, feel free to do so, complimentary, especially if you're a client. If it's been a while since we talked, it's important that we communicate frequently. But whoever it is that you work with, make sure that they understand your benefits plans if you work for a corporation, because that could be the vast majority of your retirement wealth. Understand the value that they're bringing to the table, as well as the cost for that value, so you can make sure it's a good fit. Make sure they have a team. Retirement Group has a very large team in our home office and representatives throughout the country, but I would not be able to do my job for my clients nearly as well if I didn't have a team behind me doing a lot of the heavy lifting. And make sure that you understand what value you're looking for. It could be a user-friendly website, easy to read statements, good performance net after the fees that you're being charged, a good relationship with a person that you have confidence is not only qualified to help you, but cares about you enough to make sure that you're doing the things that you're going to do, not just at retirement, but for the rest of your life potentially. And make sure that whoever you work with has a detailed financial plan, so you have confidence that they're giving you investment advice that's appropriate for you and not just everybody that they talk to. This QR code will allow you to schedule a meeting, whether a web meeting, in-person meeting, or maybe just a phone consultation. And the QR code here on the right is a way to follow us on LinkedIn so that you can make sure to keep up to speed with all of the content that we're coming out with, whether it's on investments, your company plans, taxes, psychology of investing, and a lot of the various retirement planning strategies that we use with our clients. This is a great way to keep up to speed with everything. So with that, we're going to wrap it up for the week, folks. Appreciate everybody's time. Thanks for joining us this Friday afternoon. Wish everybody a safe and healthy weekend, and we hope to talk to you all again very soon. Thanks again, folks.